So transaction 6, what we're going to do here is we're going to purchase 15 robotic units as inventory for $750,000. This part will become important later on when we get to chapter 4 in particular, that $50,000 per unit. Okay, but for right now, we're worried about that $750,000. How did we do it? Okay, well, if we were in a seated section, I would wait for one of you guys to answer me. I know that's not going to happen here, but we purchased, meaning cash. So what did we get? Well, we lost a little cash and we got some inventory for it. Inventory, as we talked about, is a current asset. We're hoping to sell this for more than that $750,000. The $750,000, when we do make sales, will eventually become our cost of goods sold, right? So that's an important piece of information for us to know when we're creating our income statement. Okay, so we decreased our cash, we increased our inventory, right? So what accounts are affected? Inventory and cash. Do the accounts increase or decrease? Well, we increased inventory, we said that, that's an asset. And we decreased cash, again, that is an asset. Do assets equal liabilities plus stockholders' equity? Yes, absolutely they do. We'll show that on the next slide to you. But again, we can see we had a net zero impact, right? We decreased cash by $750,000. And we increased inventory by the same amount. If I could, right. So we can see that equals zero total, meaning no net impact. Now, this is an excellent question for an exam. Okay, it would be worded like, let's say, Eagle Robotics purchases 15 robotic units as inventory for $750,000. What is the net impact on the accounting equation? Your answer would be $0 net impact. Okay. So here is us taking a look at the transaction itself. Okay. We really need to understand the expanded version of the accounting equation and understand each of the components of the accounting equation. We talked about that briefly in one of the other videos, but I cannot understate the importance of not just memorizing this equation, but understanding it, understanding the components of it. So it's important to understand that assets equals liabilities plus stockholders, that's your fundamental equation, right? But then you really want to understand this portion down here too, right? This is part of your retained earnings, okay? So you really want to understand that. That's this part right here, okay? Revenues minus expenses. And then when you reduce that by dividends, that's when you get retained earnings, okay? So make sure you really understand these. It's going to help you a ton when you are looking at questions that ask you about revenue increasing and how does that impact your accounting equation, right? Because we know that it increases your revenue, but what does it do to retained earnings? What does increasing dividends do to your retained earnings, right? And what does that do to your equity, right? So how does an increase in revenues impact your equity? Well, it would increase your equity, okay? That's why it's important to understand this entire thing, this entire expanded version of the accounting equation, because you want to be able to follow from the income statement all the way to your balance sheet. So let's look at transaction 7 here, okay? We sold robots, 5 of them, for cash, $70,000, and on account for $280,000, okay? So what's this telling us? Well, it's telling us we sold $280,000 on account. This means AR, accounts receivable. And we sold $70,000 for cash, okay? So it's going to be an increase to AR and an increase to cash, okay? We're going to have a total of $350,000 of revenue, okay? So hopefully everybody's following along so far. So what accounts are we actually going to be impacting? This is a big one. This is one of those compound transactions that we talked about, okay? So the first one that we've increased or that we've impacted is going to be inventory, right? We've sold inventory. We've gotten rid of some of that. So it's going to be a decrease, okay? We've sold some of them for cash, okay? That's going to be an increase to cash. That's going to be a plus to cash, a minus to inventory, okay? We sold another amount of that on account to AR, to the receivable, okay? That's going to be an increase to an asset, that AR, okay? We know we're going to count this as revenue, right? $350,000 as sales revenue, that's an increase to revenue, okay? And then our cost of goods sold, right, is what? Well, we sold 5 robots for cash, okay? How much did they cost us per robot? Well, it told us in transaction number 6, right, that we paid $50,000 per unit. Okay, and recall I told you that $50,000 per unit and that $750,000, these two are going to become your cost of goods sold, right? So now we're feeling the impacts of those costs of goods sold. Let's go ahead and look at our equation. Do they balance? Does the equation still balance? Do assets equal liabilities plus stockholders' equity? We've said it 7 times now, but yes, it must be yes, right? So let's walk through this slowly here and let's look at our transaction. So we sold $70,000 worth of robots for cash. We sold $70,000 worth of robots as AR. We bring those down to our totals. Now we know we have $400,000 in cash total. We have $280,000 in accounts receivable, $14,000 in supplies, $180,000 in prepaid rent. Now, we also know that we got rid of $250,000 worth of inventory. How do we know that? Well, we know that because we sold 5 units at $50,000 a piece equals $250,000 worth of inventory. That is what it cost us to get those in our inventory, right? That is our cost of goods sold. Okay. So now we also know that we have $350,000 in total sales revenue. That's from these two right here. And then we have $250,000 in cost of goods sold. That is what matches up to this, right? So I know this one's a little trickier than what we've been working on, but I hope you guys can understand it as we start to see it in its actual journalized form, okay? So you can use these charts to kind of help you determine how the changes in revenues and expenses are going to impact your actual expanded accounting equation, right? So when we recognize revenue, we're going to increase revenue, right? And then that increases net income, which in turn increases retained earnings, which in turn increases stockholders' equity. I like to show it like this. When you come into my office and talk to me, or if I'm showing it on the board, we just break these down. Common stock and retained earnings are your portions of equity. Then you have net income and dividends as your portions of retained earnings. And you have revenues and expenses as the components of your net income. So now, boom, we've got our entire accounting equation. What happened? Well, we increased revenues, which increases net income, which increases retained earnings, which in turn increases our equity. This is why I think it is so helpful for you guys to write these down. Write this fundamental accounting equation out. Write I would recommend writing the expanded accounting equation like this out and just follow it all the way through, right? Follow what's happened all the way through. And you can very, very easily answer any questions that would ask you, how does this impact your accounting equation? Because I'm going to give you a little spoiler right now. I love those questions on an exam. Absolutely love asking, how does this impact your equation? So you have been forewarned, if you've watched these videos, that I like asking questions about the impact on your accounting equation. And when you are writing out your scratch notes on your scratch paper, I fully expect to see the accounting equation written out and you walking through each step. So again, step 1, revenues increased. Step 2, net income's increased. Step 3, retained earnings has increased. And finally, step 4, your stockholders' equity has increased. What's happened here? Well, income statement, balance sheet, statement of retained earnings, statement of retained earnings, and then finally your balance sheet, right? So that's your impact, okay? When we recognize expenses, it's kind of the same thing, right? Well, we increase expenses. What happens when you increase expenses? Well, it reduces your net income. It decreases your net income. What happens when you decrease net income? When you have less net income, you have less money to retain, so your retained earnings decreases. What happens when your retained earnings decreases? Well, your owners have less that they own, so your stockholders' equity has decreased, okay? Same concept, right? Same concept as before, okay? Just write it out if you have to. I would recommend doing it. You know, A equals L plus E, then you have common stock and retained earnings, then you have net income and dividends, and I always put these in parentheses so I remember they're negative and that they decrease retained earnings, okay? Then you have revenues and expenses. Again, I put it in parentheses here because this is a negative number. It decreases our net income. So if expenses have increased, then net income's decreased and retained earnings have decreased. Stockholders' equity has decreased, right? 1, 2, 3, 4. You can follow this through. Income statement, statement of retained earnings or stockholders' equity, balance sheet, okay? So that is the way to do these, okay? One thing I do want to note, and this is extremely important, deferred revenue, and we will talk about this much, much more in the future. Deferred revenue is not a revenue account. It is a liability. Remember, in accounting, we only recognize revenue when we've provided the service, when we've provided the good or service, when we've met our end of the deal. If we have not done that yet, and they've given us cash, that is a deferred revenue. We are deferring that revenue into a future period. Okay, we're pushing it into the future. And until we earn it, it's a liability. We still owe them. Think about this like the gift card that you buy or the plane ticket that you buy, right? Until they give you a ride on their plane, they still owe you a ride on their plane. And it's a liability for them, okay?